Thank you so much for having me. I wanted to, let's just call it re-underwrite one of our favorite short ideas. And honestly, in my career, I've been doing this for a long time at this point, about 10 years of this particular franchise. This is maybe the best short idea that I've come across in my career, which is Trupanion. So we wanted to present 11 facts about the company and then one opinion, which is, of course, our view that the stock could trade below $10 a share. Just very quickly, some of you may not know who we are. We're an independent research firm. We differentiate ourselves based on the rigor of our analysis, our primary research, and I think we want to be known as a firm that generates money-making investment ideas. And on that front, on average, our typical investment ideas generate about 38% alpha. We've had really good success both on the long and short side. With that, let's dive into Trupanion. It sounds crazy to say, but it is important to remember that Trupanion is a pet insurance company. It has been positioned to the street as a technology/SaaS story, and I know the market is rife with all sorts of absurd story stocks and TAM stocks, and I think this would be at the top of the list. What excites us about Trupanion is that, unlike some of these other stories, there's ample evidence that the company will never make money, will never be profitable no matter what happens. Trupanion is the second largest pet insurance company in the United States. They have about 500,000 pets, which they call subscribers. I call policyholders, call me old school. The company has come to market with a slightly differentiated product, which is they pay out 90% on claims. They try and process claims more quickly. And importantly, they rely on the veterinarian channel to win new business, to sign up new customers. They use something called a territory partner model, which are independent salespeople that are not employed by the company. Just at a structural level, their use of the territory partner model and acquiring customers in the vet channel creates what I would call a grand exercise in adverse selection, in that when you go to the vet, obviously you have, not in every case, but in a lot of cases, you have a problem with your pet. So they're getting a lot of pets that already have some sort of health issue. So here's a chart on Trupanion, which this is, I guess, an all too common chart, which I say, what the hell just happened here in the last few weeks, or really in the last week or so. Company reported a slight beat on earnings and the stock went up roughly 40%. It is conspicuous if I were to show you this chart compared to consensus estimates for 2020, 2021, 2022. You have what we call your classic alligator jaws, where the stock has gone up and estimates have gone down. I certainly am of the view that those jaws eventually close. So this has all the trappings of what I would call a traditional short squeeze, even though the short interest was coming down in front of the earnings. I expect it's much lower now, even as of today. So let's get into the facts here, the facts of the case. And for the case of Trupanion, if you talk to anyone who's long the stock, this is exactly where their bull case more or less starts and ends, which is that pet insurance in the United States, the penetration is about 1% to 2%. There's about 184 million dogs and cats in the country. As of the end of last year, there were only 2.5 million policyholders of pet insurance in the United States. And people say, okay, well, in the United Kingdom or in Sweden, the penetration rates are 25 or 40%. So this is just a huge runway, and this is all manna for the total addressable market crowd, the TAM crowd, which I think everyone at this conference understands what kind of stocks have benefited from that kind of thinking. The one thing I would point out is that there's several things. One, pet insurance in the United States is actually very expensive, and it's very expensive relative to the cost of veterinary care. So the average spend, and some of this data is a little old because the last time I've been able to find industry data like this, but the typical vet visit is about $150, $200. The average consumer is spending $350, $400 a year. It is important to point out that there's a lot of luck involved in how much you spend at the vet. As you can see from the table on the left here, you have 25% of pet owners in a year might not spend anything. And then there's also a significant stratification in this chart on the right, that those who are lower income don't spend anything or very low levels on vet expenditures. So I think there needs to be a more nuanced look at the market, because if you look at the UK, the spending on vet care is a lot lower than it here in the US, and the pet insurance policies are also less expensive. So what I did is to try and give a more realistic view of what the TAM is and say, okay, given that the average pet insurance policy, whether it's Trupanion or any of the other competitors, costs anywhere from $500 to $600 minimum. In the case of Trupanion, a lot of their policies start at $1,000 plus a year. So there is a growing argument that, like, should I self-insure? But if we just look at those who are making more than $85,000 a year, you say, okay, the penetration rate is 8.5%, 9%, and moving quickly into that TAM, or eating into that TAM much more quickly than most would expect. Fact number two, the people who are believers in the TAM would argue that, okay, well, today Trupanion has 500,000 pets. When they get to 1 million pets, that's when their profitability will really start to improve. In the chart on the left here, I've shown you the underwriting profit margin for the company. There's no scalability whatsoever in their margin. Their underwriting profits are the same as they were 7 years ago when they had, a couple 100,000 pets. So the idea that this business model scales is absolutely untrue. And keep in mind that this underwriting profit margin does not include their marketing spending, which is going through the roof, which we'll get into. This is critical. There's been a huge tidal wave of new competition. This is fact three. I would highlight that White Mountain, which is a public company, acquired Embrace. Synchrony, which is a public company, obviously, big credit card issue, and has Care Credit, which is a big player in the vet channel, acquired Pets Best in a very strange scenario. Pets Best is the underwriter of record, technically, for Pets Best is Trupanion's American Pet Insurance Company. In addition, more recently, Zoetis launched their pumpkin offering. You have Marsh Mac, which launched Trusted Pals. MetLife acquired Pet First. Then there's Lemonade, which is now coming into the market with a $12 per month offering, at least headline pricing, whereas Trupanion is $80 to $100 a month. So this is a huge problem for the company. And I think this is not well understood, because the company's management has done a remarkable job of saying, well, we are the industry and we get 40% of searches for related to pet insurance or involve our brand. That's unequivocally untrue. And what you can see now is there's a structural shift in how customers are acquiring pet insurance. Instead of solely through the vet office, you're seeing more and more query volume. So on the left, you see that Trupanion's query volume has barely grown, whereas that for the category is up 20-25% this year, more so in recent months. And this is a huge problem, because now Trupanion is losing customers at the top of the funnel. So if I look at this, and on the left, I try to give you a screenshot of Trupanion has avoided spending in the SEM channel and digital channels, because currently they pay $10 for a new customer through their territory partner model. The average cost per click, let's say in the Google ecosystem for pet insurance, is $8 to $10. Let's say you convert that at 5%, 2.5%, 10%, whatever number it is. They're paying multiples. They would have to pay multiples if they have to move into the digital ecosystem. So this is a structural problem. From an SEO perspective, Trupanion is ranking like 4th or 5th behind some of the bigger players, whether it's Nationwide or Healthy Paws or some of these other players. So they have a huge problem in the consumer channel in terms of competitive share loss and cost of acquisition. So if you look, here's a quote from the company's last earnings conference call, in which they argued that they were taking share, basically, that they have been the leading revenue grower in the category. That's just factually untrue. So in 18 and 19, according to the industry data, which is an association called NAFIA, Trupanion's growth rate was slower than the overall industry. This chart on the right is absolutely critical. So people were celebrating the fact that Trupanion grew their core subscription business 19% in the second quarter. As you can see, they lost enormous share, because we saw a huge increase in demand for pets in the second quarter as a result of the COVID shelter-in-place orders. Everyone was adopting pets or going to shelters. But you see Embrace, Pets Best, Pet Partners, Healthy Paws, all grew multiples of the company. And I expect this dynamic to continue. And here's another critical dynamic for the company. Their pet acquisition cost has been going through the roof. And some of that is that they've exhausted their territory partner model in terms of its efficacy in the animal hospitals that they're targeting. And they've had to spend a little bit more on traditional consumer marketing, and they keep toying around with trying to come up with an effective model, and they are really struggling with it. In the second quarter, their pet acquisition cost was a little lower, but that's because they basically spent no marketing dollars in April. So as that normalizes, you're talking about them spending $250, $275 to acquire a single pet, which means with PAC growing faster than the company's revenue growth, they will never become profitable, never. And here's where the structural short elements really start to take root. At its core, pet insurance is a very difficult business to underwrite profitably. A number of new pets, huge growth in younger new pets who have, as you see in this table here, their claim frequency and their the amount in claims as they're younger are low. But as they age, and the crossover period is around years 5 and 6, the claims rate, the frequency goes up and the cost per claim goes up. So in the case of Trupanion, what the company has been struggling with in many of their markets in their largest states is that they're constantly having to increase price to offset rising losses. So here in this chart, or in this table here, you can see that in some of their top markets, they're increasing price 15 to 20, 25% plus. And obviously that's from a pure elasticity of demand perspective. That creates a problem for what policyholders are willing to spend, given that obviously you can always just say, I don't think my pet will get injured. And if I'm going to spend $1,500 a year pet insurance, I'll just put that money aside. And if something happens, I'll pay for it. But perhaps more importantly, competitively, as this chart demonstrates, Trupanion has the most expensive policies at this point by a wide margin. And this is part of the reason, not only because of their issues in the consumer digital channel, but that also competitively, they just do not have a compelling offering from a price perspective. And that dynamic with all of this new competition in this space is causing them to lose share. Now, what happened, which I think is critical, this idea that loss rates go up as pets get older, they increased pricing in Florida over 200% over a 7 to 8 year period. And what happened is, as the company pointed out, that their lead flow in that market and their conversion rate was 26% lower than their other top states, which basically says as the price goes up, no shock that demand goes down. And so they have this pricing problem, this loss rate problem in all of their major states, California, New York, New Jersey. They had it in Florida, and they had to restructure their insurance policy, and they no longer offer a 90% reimbursement rate. There is a proposal currently from the National Association of Insurance Commissioners, the Pet Insurance Working Group. My expectation is this could be put into place by the end of this year, which would allow insurance agents and insurance brokers to compensate vets for enrolling a new pet. Now, if you think if there's a singular moat around Trupanion, which I would argue there is none, but if you are a bull, you say, okay, there's a moat because they have great relationships in the vet channel. But this proposal would allow that anyone could go into the vet channel and say, well, instead of paying you $10 for a new pet, or they don't pay the vets currently, excuse me, they could pay $25, $50, $100 for a new pet, which would still be cheaper than some other channels. So this would be a disaster for Trupanion, in my opinion. Just a point on the second quarter results, obviously the market reacted very strongly to them, which I thought was kind of ridiculous. They had 4 things that went in their favor that were all entirely related to COVID and also not sustainable. They had lower claims experience because consumers just didn't go to the vet as much, obviously. They did see a big uptick in new pets for the industry because a lot of people were adopting pets as a shelter-in-place activity. They did not spend as much on marketing, particularly in the month of April, early May, and they had higher reported retention. The company has offered 90-day grace on their payments from their policyholders, and they reported that as an improvement in retention, which is utterly absurd and consistent with, let's just say, the overall promotional nature of this company. Trupanion has seen their DSOs double over the last 2 years, in part because they have this other business where they're the underwriter of record for Pets Best, which is owned by Synchrony, one of their competitors. They should not, in my opinion, be recognizing these revenues at all. Pets Best administers the claims. They process all the premiums. Trupanion basically has no direct involvement, but they're creating these ridiculous accounting entries, which has caused their DSOs to go through the roof, and they've also booked these offsetting deferred revenues. The only reason I bring this up is because the growth rate in the other business has been more than 3x the core subscription business. And people view this company, instead, if they were growing at, they're reporting at 30%, instead they're growing at high teens, not to mention the overall size of the company would be different. This is a highly questionable accounting practice, and I can get into that in more detail. Lastly, and as a policy, as a firm, none of our short ideas are predicated on valuation, but it should just be pointed out that, at 18 times tangible book value for an insurance company, that is just off the charts as to what would be normal. When I look at comparable transactions, so White Mountain bought Embrace for $500 to $600 per pet, 1.2 times revenue. Synchrony paid a similar multiple for Pets Best. Trupanion's trading at 5 times revenue and over $3,000 per pet. There is no support, even on if you say, okay, well, somebody would want to buy Trupanion as a strategic. No one's paying more than 1 to 1.5 times revenue. So, in terms of those are the facts, and in terms of our opinion, we think that Trupanion, our expectation is that it'll eventually trade below $10 a share. The company is in what I would call a classic insurance rate spiral. And for those who don't follow insurance or have never looked at an insurance business model, that's a scenario where a company is experiencing higher loss rates. They try to offset those higher loss rates by increasing price. The price exacerbates churn. And then you have this dynamic where there's adverse selection in the policyholder base, where the policyholder base, only those consumers or policyholders that have higher losses stay on the platform, and so the company continues to have higher losses and they have to increase price. This is absolutely what is going on. So you can look at any of these are publicly available documents. In all the states that Trupanion operates in, they have been increasing price because they have higher loss rates. And now you have a company whose average base rate premiums are the $80 to $100 level in their biggest states, and you have competitors who have prices in the offerings in the market at $40, $50. So the company is undercapitalized. They're in the early stages of an insurance rate spiral. They have questionable accounting. These are all what I would call facts. And I think as we go forward, you're going to see slowing new pet enrollment, which then will, again, cause their overall loss rates to increase. They probably will have to back away from their 90% reimbursement model in more states. Going to continue to lose share. Pet acquisition costs will continue to go through the roof. And I think you'll see a lot more insider selling. And eventually, I think this company should be raising capital immediately. And that's Trupanion.
All right, that's very interesting. Thank you so much, Bradley. I do have a question here. What will finally cause the stock to crack? They seem to get a pass on all these issues, and the stock keeps going higher. So, yeah, what is your?
It's a good point. Candidly, I thought if you said about a year and a half ago, when their pet acquisition costs started to skyrocket, I thought for sure. Forget the fact that it's an insurance company, but even if you were following on what is a traditional subscription business, and say, okay, anyone who's followed these businesses knows that as customer acquisition costs, or in this case, pet acquisition costs, starts going up meaningfully, the business can never drive kind of those incremental margins that people expect. So I'm disappointed there. I think you have some harder catalysts. Like for me, I think if everyone understood how much market share the company lost in the second quarter, we're finally getting public company disclosure around that. So you'll see White Mountain talk about their business, Synchrony will talk about their business, Lemonade, Zotis, that will certainly help. Eventually, I think as people get exhausted by the fact that the company's losses will likely go up, not down. And I think the biggest single catalyst will be when their new pet enrollment slows, which I think is you're going to see in the next 2 quarters.
All right. Very interesting. Bradley, thank you so much for that.